Hello, traders. FS Percoletta here. Today is Wednesday. It is September 18th. So, how's everybody doing? Hopefully, fairly good. I got the US dollar index pulled up here if anybody's curious. So, anyways, big day today, definitely for the dollar, especially, but these big dollar events definitely do affect all kinds of different currencies because the yen, the Swiss, the Aussie, and probably gold and maybe even cryptocurrencies are risk on, risk off currencies. So basically, if the dollar goes up, then normally those risk on currencies go down. And vice versa, if the dollar goes down, normally those risk on currencies go up. So this news today is probably almost definitely going to affect the yen, the Swiss, probably the Aussie, but a little bit of everything, honestly. Now, they are planning on cutting the rates 25 basis points. I've actually heard from a lot of different people that they're actually planning on lowering it 50 basis points. That's what a lot of people are saying. And I kind of agree with them. I think that is the more likely scenario is that they're going to lower it 50 points. But with the election coming up in the U.S., maybe they're going to play it safe. Maybe they're just going to lower it 25 points because it is an election year and it's what only October, November. It's probably like 2 months now until the election. So yeah, they may play it safe. Like I said, almost everybody I've been hearing from says 50 points, but the forecast is 25 points, and I was thinking 50 points too. Also, that's definitely what I was thinking. But now I think about it a little bit more. With an election year coming up, I do think there probably is a better chance that it's going to be 25 points, just because they don't want to do anything too dramatic with the election coming up. But we'll have to see. Time will tell. Now, if they really do lower it 50 points instead of 25 points, that's when the market is just going to go wild. I think that's going to be a very, very, very wild, very volatile move. Probably lots of traps and everything else. So we'll have to see. We got about 29 minutes, so let's get to the chart. This is the US dollar chart on the weekly time frame, and the US dollar analysis for me is definitely the most important analysis for sure. And I think, at least for the dollar pairs, it is. And I've been thinking that this was going to go down and finish off a wave C. I mean, my target has been, someplace down in this area for probably almost a year now or more. Now, this also to me looks like a wave one. This looks like a wave two, and I do believe this is a wave three. If you've seen my full top down analysis on the dollar pairs and you see why I believe that all the dollar pairs are going up for wave three, it's only solely based on what I see on this US dollar index. I do believe there is a very good chance this is going to go down. But, shorter term, looking at this thing on the daily, look at this pattern. One wave, two wave, three wave, four wave, five waves down. It seems very, very clear to be five waves down, like really, really clear. Now, I was trying to figure out maybe if this move down right here was possibly a correction, like this move up right here was possibly a wave A, this move down was actually part of a wave B, like a flat, and then possibly go back up for a wave C, and then end up continuing the downtrend, because my bias is definitely bearish on the dollar. So taking it down a little bit further to like the 4 hour time frame, if this really is true, then this little section right here needs to be a correction. It needs to be a trend. It needs to be three waves, and it needs to be a trend. So, update. Yeah, so basically, to me, it's very obvious that this is a trend. I mean, there's no doubt that's a trend. This is also a trend, right? That's lower lows, lower highs. To me, this is definitely a trend. That's a little series of lower lows, lower highs. This definitely looks like one, two, three waves up. So the more I think about it, the more I look at it, I definitely think this is probably, I mean, there's no definite when it comes to the market, that's for sure, but I do believe that this is an ABC correction. I think that this first push up right here is a wave A. I think this is likely an ABC, a B, and I think that we're likely to actually make a big push up for a wave C, and we're probably going to take out these highs. Then I think there's a very good likelihood it will reverse back down and probably try to trap everybody. So that's definitely what my forecast is on these pairs. I mean, to me, the dollar seems very clear. The only thing that isn't really totally clear is whether it's going to do a big old spike like that or if it's just going to take right off to the upside. Normally, it does do a spike reversal at these big news events. And what I mean by that is normally it'll spike in one direction, a lot of pips, and then it'll pull back all the way to the starting line. And then during the press conference is when it actually, takes off in one way, one direction or the other. So we're gonna have to decide whether we want to wait for the news to come out. I mean, honestly, there's probably a very good chance if it does take off, it's gonna pull back. It's gonna come almost all the way back to the starting line. So the safer thing to do would probably be wait until the news is out, wait until it pulls back to the starting line. That's probably the safest thing to do for sure, especially with the fact that I had to look it up because I wasn't sure, but the last time that they cut interest rates for the US was in March 2020, so it's been about 4 years and almost 6 months or so, about 4 years and 6 months. Actually, pretty much exactly 4 years and 6 months. So it's been a long time since they've cut rates. So it could have a pretty wild move ahead of us today for sure. It's going to be kind of exciting. I got my popcorn ready. I'm ready to go on this one, that's for sure. I'm not going to go and do a top down analysis because we only got about 20 minutes and we don't really have time for that. And my analysis that I'm providing on every single one of these dollar pairs, including gold, is based on what I just told you was going to happen on the US dollar index. 99% of my analysis that you see on the dollar pairs is based on what I see on the US dollar index. All the dollar pairs are doing very similar patterns. They're doing different patterns, but they're all very similar movements, especially on the very high time frames like the weekly and monthly time frame. So, based on what I was just saying on the dollar, I think there's a pretty good chance that this is an A. I think there's a good chance this is an A, B, C of B. I think there's a very good chance this is going to go down and make a wave C. And then maybe later today or maybe in a couple of days, it's going to reverse back up and continue the uptrend because I do believe we are in a big wave three on the very, very high time frames. Like I said, I'm not going to do my full top down analysis because most of these dollar pairs I do make full top down analysis videos for every single day. So probably not going to do that, but for time's sake. So So yeah, we can check out the S&P 500. I literally just made a video for that too, but we can definitely check that out because if the dollar goes up, the S&P 500 will likely go down. But then if the dollar does reverse back to the downside, the S&P 500 will likely go up. So it's pretty much the exact same thing I showed on the dollar. Usually if the dollar goes down, the stock market goes up. So anyways, to me this looks like a trend. I think this is more of a trend too. I think this is more of a correction. I think this is definitely a trend. That tells me that this is probably a wave B right here. This probably is going to end up going down for a wave C in my opinion. It definitely, boy, it does look pretty clear. Like I said, the only question I really have about the news is whether it's going to do like a spike reversal like that. Is it going to be like a big spike reversal? Is it going to go up and stop everybody out and then reverse to the downside? Or is it just going to take right off to the downside? We're going to have to watch and see. Aussie dollar is sitting right at the 78% fib level. Aussie dollar is actually quite a bit different than a lot of the dollar pairs. This one just looks like a potential 1, 2, 3 pattern, and then it looks like just an overlapping uptrend. But obviously, if this happens to the euro dollar and the pound dollar, then I would expect to see basically the same movement on the Aussie dollar, and maybe this is actually supposed to be only a wave A, and this is supposed to be a wave B, and then it goes down, makes a wave C, and then continues the uptrend from there. Or just like the dollar pairs, this is the wave A, and technically this is like a very odd-looking wave B, and then it goes down for a wave C. Which, I mean, wave B's are corrections, and corrections can make all kinds of weird-looking patterns. So if that was a wave B, that would definitely make sense. Probably end up doing something like that, and then probably reversing back up. I don't think it's going to do a double reversal today. I would kind of predict it might trend down for a few days, and then maybe at the end of the week or maybe next week it would reverse back up. So let's check out the Kiwi dollar. Yeah, well, the news, based on fundamentals, the news is actually negative for the dollar. A lower interest rate means that money actually goes other places for higher yields. So a lower interest rate is normally actually negative for the dollar. A higher interest rate is actually normally positive for the dollar. But in my experience, fundamentals almost never line up with what you see on the chart, at least on the short time frames. On the higher time frames, fundamentals probably do line up. But what happens intraday on these sort of time frames almost never lines up with what you see based on fundamentals. The market, I mean, I've seen the most positive news ever for the dollar, and then the dollar just goes down for days and days. But then it ends up reversing and going up once it's satisfied that it stopped everybody out. But, anyways, I definitely am looking at this as a trend. I'm looking at this as a trend. To me, this definitely looks more like one, two, three waves, and then this looks like a trend also. I think that I do agree it might spike up, but boy, I'm predicting down. Now, anybody could be right on this. I mean, honestly, I mean, math could be right. The dollar could just rally like the dollar could just go up like crazy, and that's what I'm predicting too. I think the dollar is going to go up also, but I think it's going to be a wave C, which means that it's going to reverse again. Yeah, let's keep going. Let's check out the rest of these dollar pairs. We got to get to gold too. U.S. dollar CAD, boy, the dollar CAD I think is in a wave two on the higher time frames, like the daily time frame, 4 hour time frame. To me, this looks like something that potentially needs to go up more also. It needs to go up to one of these higher Fibonacci levels, complete a wave two, and then possibly reverse down for a wave three, a wave four, and a wave five. I think this is going to go up to at least a 50 or a 38%, maybe even a 61% before it actually decides to reverse. Boy, some of these pairs really do look like spike reversal type thing, though. It looks like potentially it could go down because to me this looks impulsive, like a wave A. This looks like one big overlapping pattern, wave B. It kind of looks like it's going to go down and then reverse back up, actually. Yeah, honestly, I do think that does look like that, definitely. So down and up. Oh, hold on, sorry. So if that's the case, that would kind of make sense to me, honestly, because we haven't quite hit that Fibonacci level yet on this US dollar. So if this actually went down, hit that Fibonacci level, and then went back up, completed a wave C, and then either in a couple days or next week ends up reversing back down, that probably would make the most sense to me, honestly. I definitely think so. So let's see here. Oops. Sorry, I was just checking out my Discord channel. If you haven't joined my Discord channel yet, definitely give it a chance. It is 100% free to join. You never have to pay a dime if you do not want to. We currently have 5,435 members on my Discord channel. It's getting to be a very large community of like-minded traders willing to help each other out. So definitely check that out. It is 100% free. I do offer a membership program too if anybody's interested, which is at my website. Um, I like to call my program Learn and Earn at the same time because definitely the purpose of my mentorship is for you to learn how to trade. But hopefully, while you're learning, you can earn also by following along with some of my swing trade setups. And I also do a Zoom meeting every single New York session Monday, Tuesday, Wednesday, Thursday, and Friday, up to 2 hours Zoom meeting starting at 1 p.m. UK time or 8 a.m. Eastern Standard Time. These meetings are live trading and live analysis. And then it also comes with a trading course, which is 35 videos long. But like I said, I like to call it learn and earn at the same time because hopefully while you're learning the trade, you can earn by following along with some of my trade setups, which I share on Discord. This week, to be honest with you, I haven't taken a whole lot of trades. I took a gold trade today, made 50 pips on it. But I'm definitely more of a swing trader. These are the trades that I've shared so far this week. This is my results from last week right here. At the end of every week, I give a weekly report. This is how many. These are all my trades from last week, and this is how many pips I made total last week. I made 502 pips last week, and these are all the trades that I took last week. I only had 3 losing trades last week, and they were all very, very, very small. So these trades all get automatically copied to the Discord channel at the time of entry. So for $30 a month, it's extremely cheap. And like I always say, I'm not looking to get rich off my membership. I'm looking to get rich off my trading. So that's why I keep it so cheap. You know, it's $30 a month is extremely, extremely cheap, especially for the trade setups I do. So yeah, if anybody wants to check that out, it's at my website FX Pip Collector. It's only $30 a month, and boy, you do get a lot of benefits, definitely. Hey, Menu, how's it going, buddy? So let's see. Yeah, honestly, that does kind of make sense. I think we're going to get a little bit of a push down, and then we're going to reverse back up. Let's keep on going. We only got about 14 minutes until the big event. So I would have to expect something similar on the US dollar Swiss too, then, wouldn't I? I was kind of thinking that the US dollar Swiss, it already broke Strutzer right there. Technically, it didn't really hold above Strutzer very well, but it definitely did break Strutzer. So if that is a real Strutzer break, which it definitely did hold above Strutzer for a little while, then potentially that should be telling us that we should be trying to buy. Hey Glenn, how's it going? Hey Menu, how's everybody doing? Everybody got their popcorn ready to go? So I think that the US dollar might spike down a little bit, grab these lows, but I think it's going to go up. Just like I said on the US dollar index. Now I look at this, yeah, I do think maybe one more little push down just to trap everybody, and then up. And this is going to be a wave A, this is going to be a wave B, and this is going to be a wave C, and then probably continue the downtrend. Yeah, nice. Got your tea ready. I was going to get some wine, but I didn't even bother. Let's see here. Hey, Philip, how's it going? Nice to see you. A lot of people from my Discord group. Wow, the dollar yen to me totally looks like it's ready to turn. All the old dogs in the house. To me, the US dollar yen definitely looks like it wants to go up in a pretty decent way, doesn't it? I think this could be a wave A, this could be a wave B, and then we're going to go up and make a wave C. And this is all an A, B, C, or B. And then this is the daily time frame, but then eventually back down for the wave C of wave 4. Yeah, we're on the US dollar analysis right now. Maybe it's going to try to go down a little bit just to complete a pattern. This looks like a wave A, this looks like a wave B, down for a wave C, and then back up. Take out these highs. A lot of the yen pairs have actually already broken structure to the upside, so I think the dollar is kind of lagging behind the other yen pairs. I think this is going to end up breaking structure. Yeah, I think this might be a good one, honestly, because it is kind of lagging behind the other yen pairs. It looks like it needs to go down. The US dollar yen actually looks like something that potentially could hold to the upside for a while, too, honestly. Oh, of course, my broker on TradingView always disconnects me right at the most convenient time. Let me just reconnect to my broker on TradingView. All right, so yeah, I think that's the case. So we've went through everything. Let's check out gold. So I was thinking gold was going to do the same type of pattern as the euro dollar, which is down and then back up. Maybe it'll try to do a little bit of a thing like that, but overall, I think gold is going to go down also. I think this is going to be. Oh, you thinking bolus right out the bat, Glenn? Boy, could be. I mean, honestly, I am very, very bullish on the very, very high time frames, so I wouldn't be surprised. I could honestly see any either happening pretty easily, honestly. I feel like a lot of these pairs need to go down before they go up. Maybe that's going to be where the spike reversal is. Maybe the spike will be down and then up like that. Yeah, really. Let's see, I guess, huh? Boy, gold is trying to push down pretty good right now. The question is whether to put some money on the line or not. Probably the smartest thing to do would be not put any money on the line. Well, I'm holding a couple Swiss trades, and I'm holding a trade on the euro pound, but those are not dollar trades. I mean, the Swiss is definitely going to move, but would I want to? If I was gonna trade something, I don't. That we had a strong pound pretty much all day today, so that probably wouldn't be a good one to try to sort. The euro dollar kind of looks like it just made an ABC correction. Now it's like getting ready to go up, doesn't it? Let's take a look at them on a little bit of a shorter time frame, like 5 minute time frame. I normally don't look at the 5 minute time frame, but yeah. I honestly wouldn't be surprised at all, Glenn, because I'm bullish on the very high time phase, definitely. Boy, that kind of looks like a wave one, wave two to me, though. Getting ready to make a wave three, which would agree with my wave four. But this is the 5 minute time frame. How much trust can you put in that? Not much. Definitely impulsive. Definitely looks a little overlapping. Yeah, pound is strong today ever since we had that CPI. So the pound probably wouldn't be the best one to even try to get it in anyways. Aussie's been strong for weeks now overall. Let's look at this index. Which currency is currently the weakest? Currently, right now, the Canadian is the weakest. Right now, the Kiwi is the strongest. The pound is second strongest. The Swiss is third strongest. JPY, and then yeah, down it goes from there. I would want a weak one, if anything. I don't really want the CAD. I guess the Aussie is a little bit on the weak side right now, which it kind of surprises me. I think I'm gonna have to try something. I almost always have to play a little bit during these news events. Yeah, I can increase it a little bit. I try not to turn it up too much because then it gets too much. Okay, here we go. That should be a little better. So we got about 7 minutes until the news comes out. Man, get your popcorn ready. I think I'm gonna try something, and I think it might be the Aussie dollar. It's gonna be like dinner money though. That's for sure. I wouldn't enter a full 1% trade. That's extremely crazy. It's gonna be like Portuguese dinner money, which is like 30 euros or something. Definitely. Hmm. I totally agree, Rob, and that's why I'm really not. I am probably gonna trade some, but it's gonna be very, 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 very small. It's literally gonna be like $30 risk on my $50,000 account. So it's like either maybe I win $100 and I go out for dinner on Friday night, or I lose $30 and I gotta eat McDonald's Friday night. Whatever. Not a big deal. I'm thinking down too, but definitely probably gonna be a messy show. That's for sure. Excuse me. Definitely gonna be a messy show, I bet. Oh, Holding Hope is in. I'm hoping those Swiss pairs. We're right about those Swiss pairs. Oh, I was started to look at that article, but I ended up going for a motorcycle ride to look at the forest fires that are going on right now, which was not very smart. The police turned me around, so the police were like, "No, turn around, Americano, get the hell out of here." Yeah, do not fear, Holding Hope is here. That's awesome. I like that. That like totally sounds like a theme song. All right. So let's see here. I put a little teeny bet in on the market. Not a big one, that's for sure. Like I said, it's like Portuguese dinner money that I put on the line. So if I'm wrong, I'm wrong. It's the difference between going to get seafood dinner on Friday and going to get McDonald's on Friday. So either way, I'll eat. I'll eat either way. So yeah, honestly, I could totally see either. I could definitely agree with either of you guys, especially if I look at the daily. If I look at the daily on the euro dollar, one, two, three ways down, that's the end of a crescent. Up it goes. Upsy daisy, you know. Honestly, the daily does kind of make me agree with Glenn, to be honest with you. I mean, yeah, this did come back up and make a double top, but that's just because the pound was so strong today. Yeah, McDonald's ain't bad. I don't eat it very often, but once in a blue moon. Speech, yeah, I gotta get that a link for that. That's one thing I forgot, menu, was to get the link for the speech. I gotta do that. So once the news is over, I'll start taking requests. We'll start looking at pairs for people. If anybody has something they would want me to look at after the news is over, especially outside the dollar pairs, then we can definitely do so. Boy, look at the Kiwi dollar. One, two, three waves down. I took away these Fibonacci levels today because I was messing around with fib levels, but one, two, three waves down, up it goes. I mean, totally on the daily time frame, I totally agree with anybody that's bullish. I mean, even this technically hasn't hit a fib level, but it could easily go down very, very easily. And gold, I'm still pretty bullish on gold. My next target on gold is 2615 dollars roughly. You got the link for the speeds, Glenn? Put in the chats for me if you would, buddy. I'd love to have it. I forgot to queue that up ahead of time. See. Boy, gold has been pretty sideways today, though. We scalped gold to the short side only for like 50, 49 pips or whatever it was today, but just that little push down. That was a okay little trade just for a couple hours, hour and a half. Yeah, here we go. We got 50 seconds until the big news event. 50 seconds. I honestly think dollar up. I'll do one last quick dollar analysis. I think the dollar might spike down just to grab this fib level, and then I think dollar up. That's what I've been thinking. I think this is an A, I think this is a B, I think this is a C. Then go down. Take your 2 pips and run. Probably not a bad idea. I'm excited to see what this does. I'm gonna watch the euro dollar just because it's always kind of my favorite pair, and it's kind of the favorite pair of most people. I'm gonna zoom out a little bit. 10 seconds. Here we go. The countdown is on. Oh, Glenn will be right, unless it's a spike reversal. Did the dollar hit that fib level? Come on. I'm too. I'm too. I don't even want to look and see what the news was. I need to wait. Ooh, the higher time frames are probably telling the correct story as always. Come on. That's what happens too when everybody thinks it's going short. What's the news? Did they lower? They did 50 points. Man, everybody was right. Everybody was saying 50 points. Yeah. They forecasted 25, but pretty much everybody was saying 50 points. All economic, economists and stuff are pretty much all saying 50 points. Ooh, look at it go. Yeah, we were talking about that in the meeting, how they were probably Honestly, I'm not much of a fundamentalist or an economist or anything like that, but I don't pay a lot of attention to the news. But honestly, a lot of people that I follow do pay attention to the news, and pretty much everybody was saying 50 points. Oh, here we go. Is it the reversal? Come on, Porcupine. Porcupine, let's go. A lot of people are short. The trading sentiment is very short right now, too. To be honest with you, I still kind of think it might go down a little bit. I still haven't changed my analysis. Swiss, yeah. Oh, hey Stefan, how's it going? Wow, Glenn was right about the old dogs all in town. Swiss trades to the moon? I hope so. I gotta laugh about those Swiss trades now, because boy, we've been talking about this for like 3 weeks. I feel like, come on. I'm just curious to see if this is gonna be a porcupine pattern. Let's watch it on the 1 minute. You want some excitement? Nice. Let's see what it does. The starting line is right here. I would bet that it's gonna get back to there. I would put good money on it. Unless the market is in agreement. If the market is all in agreement that it's going to go up, then it'll just keep going up. Yeah, definitely. That's funny, yeah. The trading sentiment was very, very short today. That was probably a red flag right there all by itself. It was like 87% of retail traders were shorting the euro, the pound, and the Aussie, and pretty much all of these pairs. What did gold do? Let's look and see what some of this is. I want to see what gold did too. Ooh, nah, not too bad. It's not a huge move. Oh man, US dollar CAD is like literally doing exactly like I said it was gonna do. Now all we gotta do is to see a reverse, and then it'll be like easy money. Yeah, I gotta get the link for the speech unless he put it in there. Yeah, he did put it in there. Thank you, Glenn. I forgot to queue up the speech. I gotta draw some horns on it. Boy, I'm not convinced this is gonna hold. Like not at all. But these news events have a way of making you do stupid stuff, though. That's for sure. All right, so yeah, let's see. The US dollar Swiss going down. US dollar yen. Boy, if it really is an ABC, it's gonna have to reverse pretty much now. If it doesn't reverse pretty much now, then it's probably not an ABC. It does look like an ABC to me right now, but it could just be. This could be the ABC right here, honestly. So the trend is down on the US dollar yen. So if you are trying to go long, you're definitely going against the trend. But these big news events are when you usually do get turns in the market. So to me, the trend is down until it breaks this structure right here. Once it breaks that structure, then we could say that this is over. And if that's over, then the whole three-way pattern is probably over. And if the three-way pattern is over, then likely it's the beginning of a wave C, which would be a wave C of wave B probably. But none of that is even valid until it breaks structure. Until it breaks structure, it could literally just do and just keep on going. Let's see. What about gold? What gold do? Ooh, gold pushing up. My next target on gold is $2,615. 2620, something like that. I gotta get this Powell speeds queued up too. We got the Powell speed starting in about 30 minutes. That's when we're really gonna know what's going on for sure. Once Powell opens his mouth, anything can happen, that's for sure. So let's see. Oh, this isn't the video. I thought this was the live stream. Who's got the link to the Powell speeds? Boy, I think that I could possibly get stopped out of my Swiss trade. Let's see here. Which I've been kind of second guessing myself ever since I entered it. It's going down pretty strong, but it could just be the last little shakeout. Boy, that pound Swiss kind of looks like something that could try to go down, to be honest with you, but it's kind of a messy pattern. But it does kind of look like something that could try to turn down. Maybe it's just a wave C, but it does kind of look like it could do that. Where's my... Sorry, there, clicked off. Oh, did you already do it? That was it? Pound Swiss. Yeah, that would be nice. We've been holding and hoping on that one for a while now. I still think by the time this thing starts, it's going to come back here. But 50 points is dramatic, and that's maybe it is going to hold, honestly. I mean, anybody that's seen my full top-down analysis knows how bullish I am on these dollar pairs, so I'm very, very, very bullish on these dollar pairs. But normally you come back to the starting line during these news events. It doesn't even look like a way B anymore, though. Yeah, Aussie dollar almost made a new high. Kiwi dollar's at the 78%, but boy, it looks pretty impulsive. US dollar CAD to me does look like an ABC, which is why I was tempted to get in, which I did, but it's like now I gotta choose between seafood dinner and ramen, the dollar ramen meal. Power speeds. Power speeds. Federal Reserve. What's live? Kansas City Feds. Is this it? You posted the link. That's the link right there. Is that this prep one right here? Is that? This is it? I don't see the video. That's not it, is it? Oh, you posted it in the regular chats, didn't you? No. Normally I have this queued up ahead of time. Man, things are pulling back. Oh, somebody posted it above. Hmm. CNN. They're ready for Powell. As soon as he shows his face, anything can happen. All right, so I don't want to sit there and watch Powell get ready for Powell. So let's kind of go through these pairs. I just want to see some of the moves. It starts in 15, 16, 17 minutes. 16 minutes. I just want to zoom out a little bit and go through and check out some of these moves that we could just got. Let's see. Yeah, I still think it's going to go down a little bit. Whether it holds or not, we'll see. But anything can happen once Powell shows his face. That's for dang sure. What about the yen? Is the yen are the regular yen pairs? Oh man, look at these yen pairs, you guys. One, two, three waves down after a break of structure. Uh, does anybody know what to do after a 1, 2, 3 pattern? Pound dollar's not the same. Ooh, I don't think it's ready now, but maybe. Don't we have Wednesday yen news this week? That's Thursday night or Friday morning? Man, we got yen interest rate coming out this week also. Oh, look at the CAD yen. I mean, the CAD yen hasn't broken structure yet, but 1, 2, 3 waves down. Boy, that's looking nice. Might have to try some of those. Maybe even tonight. 1, 2, 3 waves down. How about the CAD? Did the CAD move? A little bit, not much. Swiss pairs aren't moving as much as they normally do. Yeah, I bet he sure does have some stories. That's for sure. They're not gonna do anything to make it Japan for now. The forecast on Forex Factory, which Forex Factory is definitely not right all the time. They weren't right today. But Forex Factory says they're going to keep it where it is, which is 25 points. Which the yen has been doing what they wanted it to do. It's been going down, so hopefully they're happy and they just leave it alone for now. Yo, Aussie, a lot of times the Aussie pairs will move too at these big news events. It's not moving much. Boy, they do look like they want to go up. Yeah, I totally agree, Glenn. Forex Factory, I don't know where they get their details, but they're not right all the time, that's for sure. There's actually quite often that they're not right, isn't it? Ooh, the pound cad's kind of topping out a little bit at a kind of important fib level. Let me put my phone on silent mode. So let's see, US dollar. Yeah, pound CAD. Boy, the pound was strong today after that news. Yeah, they probably just flip a coin or something. The Swiss is still kind of holding in there. Oh, holding hope, man. Phew. Like I said, I kind of got to laugh about it because we've literally been talking about this for, what, 1 week, 2 weeks, probably 3, 4 weeks altogether. We've been talking about this Swiss trade. It's not really taking off like we would like it to. Things are not really moving too much outside the dollar. Aussie yen, boy. My initial thoughts on the pound yen was definitely down, but I'm kind of convinced either way on that one too. Yeah, so let's see. Hold on, my wife always forgets that I'm live streaming until like 8:30 on FOMC, and she gets home at 7:30. All right, so let's see. Boy, I don't know. I definitely was initially thinking down, but Yenberry's very convinced about up. Glenn is convinced about up, and this pattern makes me think up. This totally looks like 1, 2, 3 waves down with the reversal. Totally does. And the yo Aussie, yo Kiwi makes me think the same thing. This definitely has more of a corrective look to it, like it's potentially going to go up. Pound yo Kiwi, same thing. Oh, man, that one's actually even more clear. Look at that. 5 waves down, 3 waves up. 1, 2, 3, 4, 5 waves down. Up she goes, potentially. Oh, the dollar's holding in for now. Pound CAD. We already looked at that real quick. We gotta see what this. I want to see if the stock market's moving too. Pound Aussie definitely has more of an ABC look to it too. Look at that. 1, 2, 3, 4, 5. Actually, it's probably 4, 5 right there. But 1, 2, 3, 4, 5. ABC. 1, 2, 3, 4, 5. Break a structure potentially already. Yeah, I see what you guys mean about this possibly being a bottom. Totally looks like a possible bottom. Boy, that looks like a flat almost. Not quite the most perfect thing ever, but 1, 2, 3. Yeah, yeah, 1, 2, 3, 4, 5. ABC up for the wave C. 5 waves down. Yeah, that looks like a flat. Possible move to the upside. Aussie CAD, man, I definitely should have held on to that baby. Woo, look at that baby go. I have it as an ABC too on the daily. ABC. Probably a wave one, probably a wave two, wave three. And let's see. Aussie Swiss. Man, that ABC is holding on the Aussie Swiss. Hopefully the other Swiss pairs follow suit. Doesn't look very impulsive on the sort of time frames though. But if you look at it on the daily, doesn't it just look like 3 waves down? 1, 2, 3 waves down, Fibonacci bounce, and golfing up. I mean, it just seems pretty clear, honestly. Ooh, the Aussie Kiwi is kind of holding above structure a little bit. I was kind of disappointed today because I was going to go short, but by the time I saw it, it was like down here. But honestly, I don't know. That could just be a pullback and getting ready to go back up, honestly. Kind of looks like it. I don't even trade these pairs, but wow, the Kiwi cat is definitely taking off. Well, I have this as either a wave C or a wave 3. Man, I've been forecasting that Bitcoin was going to go up for weeks now, and it's just hasn't really done anything. Gold's holding up a little bit. Oil's not doing much. Natural gas. Stock market. Nice. My target on the stock market is the minimum 5,900. Honestly, that's like the minimum, so this thing should actually be like that. That's my target on the S&P 500. I've had this like this for a very long time. Yeah, that's what we're here for, is the Fed cut. That's why we're here. We're waiting for Powell to start now. We gotta wait for Powell to open his mouth. Won't be too long. While we're waiting, if anybody has not joined my Discord channel, definitely do so. A lot of the people you see me talking to in the YouTube chats are actually people on Discord that I know. So definitely join the chat, join the community. It is 100% free to join. If you don't want to pay, it is 100% free to join as long as you want. I do have a membership, which if you would like to check that out, definitely do so. The website is FX Pip Collector, and the free Discord channel is the second link that I'm putting in. It is only $30 a month to join my website too. It's very, very cheap. I like to try to keep it as cheap as possible. Try to make it so it's well worth the money, that's for sure. Yes, we are, he says. A lot of people from the Discord channel in the chat, so definitely join up. We try to help each other out. We try to share analysis. Nobody is right all the time, so when you have people to fall back on, it's really, really amazingly helpful because nobody is right about their analysis all the time. So when you have other analysis to fall back on, it's extremely, extremely helpful. I know, crypto's really not going up, is it? Yeah, I know. I get paid in dollars too, and the dollar, boy. I was just talking to my wife about that yesterday, Glenn, because usually every 6 months we transfer dollars into euros into our bank account over here in Portugal, and boy, it's not looking good. Yeah, you get that. Nice. Heck yeah, Nay. Nay is killing it. Yeah, crypto's not really going up much. It is pushing a little bit, not much though. Not without a fight, yeah. I'm definitely bearish on the dollar. I personally think it's a wave C, but one, two, three, four, five. I was totally thinking that it was going to push up today, but that was a counter trend move, and boy, it doesn't have to counter trend, that's for sure. I was thinking that it was going to go up and grab these highs and then go down. But boy, it definitely doesn't have to do that. It could definitely, definitely keep on trending because the trend is your friend. As always, the trend is your friend. The trend is always your friend. Sometimes you have to just navigate to a different time frame in order to figure out what time frame it's on. Yeah, Elliott Wave is the Goku is the main tool that I use in my trading. My trading course is right here, which comes free with the membership. I cover Fibonacci, I cover trends and corrections, risk management practices, structure analysis, Elliott Wave analysis, some trading psychology suggestions, tuning the frequency of your charts, which I think is the key to Elliott Wave that most Elliott Wave traders miss. Most Elliott Wave traders think that they can go to any time frame and just put an Elliott wave count on and it's going to work. I am a big believer that Elliott wave only works properly when you tune the frequency of your charts, and how to put it all together to be a consistently profitable trader. There's 35 videos here, and it's about 7.5 hours. And then I also do a live stream every single day where we analyze the markets together. A lot of times we have other people get on the mic and say their analysis. Every Monday, Tuesday, Wednesday, Thursday, and Friday we do a 2-hour Zoom meeting. Starts at 1 p.m. UK time or 8 a.m. Eastern Standard Time, New York time. And like I said, it is only $30 a month, and I do say every single trade I take at the time of entry. Uh, this week I haven't traded a whole heck of a lot, but these are my trade. I mean, I did have a few trades this week, but this is my weekly report from last week that is generated by my broker with an EA. And these are all the trades that I took last week right here. This is every single trade I took last week, and with a total of 502 pips profit last week. Last week was an amazing, amazing week for us. This week I haven't entered a whole heck of a lot of trades just because I didn't see a whole lot of opportunities yet. Kind of trying to be patient, waiting for good, proper setups. And even on a good week, I only take 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Yeah, it was 15 trades last week. To be honest with you, most of the time I probably only take like 8 to 10 trades. Yeah, Elliott Wave is definitely the main tool that we use. Some of the people in the group are really, really good. Glenn is awesome at Elliott Wave, and Stefan, and really everybody. And we all help each other out, Holden Hope, everybody. We try to menu, try to help each other out so that way we can get some good, accurate counts. I spent about 10 years in a trading community, and I really don't think I would be successful at trading at all if it wasn't for the trading community that I spent so much time in. Now I created my own community because I think community is extremely important when you're talking about trading, because nobody is right about Elliott wave counts all the time. And when you're wrong, it's really nice to have other counts to fall back on. It makes it a lot easier. So anyways, yeah, boy, we gotta wait for the power speeds. The power must be about ready to go. Oh, wait, this keeps opening up. Yeah, I know what Wyckoff theory is. Accumulation and distribution. I know most trading strategy. I know a little bit about most trading strategies, but my edge is definitely structure analysis, Fibonacci analysis, and Elliott wave analysis. Power speeds. Here we go. Yeah, like I said, I know a little bit about most strategies. I recently kind of learned a little bit about hedging because that Nay guy that was just in the chats a little while ago, kills it, and he does a lot of hedging. So I was recently trying to educate myself on that a little bit. I like to learn new things when it comes to trading. Yeah, the speech is about to start. It should be starting really any minute, any second. Look at the chat. Holy crap, you can't even read it. It's going so fast in a minute. Buy before the speech or something like that. I don't even know. Here he comes. Is he coming? The second he shows his face, the market's probably going to move around a little bit. I probably don't even have the best one here. The best. Oh, here he comes. Oh yeah, the second he shows his face, I see my P&L bouncing all over the place. All right, what's he got to say? I'm not sure if you guys can hear it or not. I can't.
context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient.
I'm out of the dollar Swiss.
Intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished, and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed that made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
Sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So, a couple things. A good place to start is the SEP. But let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of what the committee is thinking today, what the individual members, rather, of the committee are thinking today, assuming that their particular forecasts are realized.
Hi, Christopher Gaber at Associated Press. Thank you. The projections show that the Fed officials officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction. And we'll be looking at the way the economy reacts to that. And that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%, and inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. What you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of opinion, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year. All 19. That's a big change from June, right? Seven of them wrote down 3 or more, 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that. Now that this is in the books, can you give us some guidance as to sort of follow this table from the pacing here? Would you expect this to be running every other meeting once we get into next year?
We're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but and I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Hi, Chair Powell. Gina Smiley with the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay, multiple questions there, but so I would say we don't think we're behind. We do not think we think this is timely, but I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably under 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrink, but also be cutting rates.
Thank you, Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. By many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
Just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate it. As you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies. something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions, meeting by meeting.
Michael Dickey with Bloomberg TV and radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? We're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We are we have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So, and policy we think is still restrictive, so that should still be happening.
I'm just curious how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be their wage increases rather are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person as measured. It's now around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, I could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change, particularly over the last few months. And so what we say is, as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
What do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get two. We get a second jobs report on the day of the meeting, I think. So, and inflation data, we'll get all this data, we'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payroll the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, then and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate, and some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, and you mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway, would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates, and it looked like the neutral rate might even be negative. So there was people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. Again, we only know it by its works.
How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah. So this is my 4th presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group, and then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind. And, it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, So very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a follow up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
With Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I could say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels. But they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this. But, the direction of travel is clear, and as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
The housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it would be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to find, to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down, getting those rates normalized, and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Hi, Victoria Guido with Politico. Just following up on some of the labor monetary policy operates with long and variable lags, and I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, um, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, business people who are actually out there doing business. So I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is let's look, at this meeting we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things and we're asking ourselves, what's the policy stance we need to move to? We knew, it's clear that we clearly, literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the paths forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
To households who are frustrated that home prices have still stayed so high as rates have been high, what do you say to those households?
Well, what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on, and I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at coming into the blackout, there was like an open thought of 25 or 50. You know, the Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, could you talk? Would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? You know, after the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do, and that's what we did today.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public, and I hope and strongly believe that it will, continue.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. Wondering if you are in alignment with him on those changes should be, if those have support on the board in the broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question. Let me we'll give you the second question. So, the answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support. That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
And yesterday there were merger reform finalizations from the other bank regulators. What does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. It was a severe labor shortage, so very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today was, I think, we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Vulnerable to a shock now that could tip it into recession?
I don't think so. I don't. There's as I look. Well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn, is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that now. Thank you.
Okay, looks like it's all over. Boy, anybody scalping gold over here? Phew. Pretty easy money, no? So now that it made a new low, you put your Fibonacci extension on there. And now that it made a new low, you got a brand new swing high to watch. Doesn't matter if it's the 15-second time frame, the 1 hour, the 4 hour, the daily, the weekly, or the monthly. It works the same. Oh, is he still talking? I thought he was done. I don't know about selling now. God. See how now that we're watching Fibonacci extension, and when we see a break of structure, we can get rid of Fibonacci extension, we can put Fibonacci retracement on here, and we can look for a reversal. If it goes up and breaks structure, that proves that the series of lower lows, lower highs is complete. Pretty simple. So let's see here. Oh wow, yeah. Looks like a reversal to me. Big time. Wow. Yeah, I think my original analysis of the way B is very likely to still correct. We need to see a breaker structure to confirm, but I think my scalp just turned into a swing trade. Breaker structure to confirm. Like I said, the 15-second time frame we were just doing, it's no different than this 1 hour time frame, or the 4 hour time frame, or the daily, or the monthly, or the weekly. Fibonacci and structure analysis is the same on whatever time frame you look at. Oh, whoop. I still got the rocket on here. Almost time for dinner. So, yeah, gold. Not gold, but the Aussie dollar. It looks like it's trying to reverse, that's for sure. Breaker structure will help confirm. Kiwi dollar. Breaker structure will help confirm. Oh, heck yeah, buddy. I got out. I didn't want to risk it anymore. Just because of the weekly time frame. Dollar CAD. We need a breaker structure to help confirm, definitely. Oh yeah, dollar Swiss. Breaker structure to help confirm. If it doesn't break structure, it's probably not a real turn. And technically, the US dollar yen breaker structure is right here. Yeah, let's see what that looks like now. Did it break structure on the 4 hour? Not yet. If I get up tomorrow and this thing breaks structure, then I'll be back in this trade, no problem. Otherwise, I'm gonna wait for a little bit. But boy, it definitely did do a little bit of a stomp out. I think my stomp out was like right at that low right there. Definitely. Break a structure will help confirm. For sure. Oh man, yen pairs. I suggest people start looking for longs on the yen pairs. Definitely. And dollar CAD, Euro CAD. Ooh, that kind of looks like it could reverse too. That has that 345 shape right there at the top. Ooh, Euro Swiss is pushing up because of the Swiss, I'm sure. I'm still long on this thing. That might not work out either. We'll see. Aussie Kiwi still looks like, yeah, Aussie Kiwi still. Euro CAD definitely has that 345 shape. A breaker structure down will help confirm a solid turn. Boy, the pound Aussie and the pound Kiwi could be the end of a correction. Yo Aussie, yo Kiwi. Aussie CAD is still pretty bullish, but now that it made that move up, this breaker structure will help it confirm probably a correction in my opinion, but at least a turn down. Yeah, well, Aussie Swiss is still pushing. Ooh, Aussie Kiwi. Kind of looks like it wants to go up again. Yeah. Ooh, CAD Swiss, yeah, like we said. Technically, you might call this the breaker structure now. Probably the best breaker structure would be here, but yeah, that could be the new structure level right there. Because it did make a new low after that swing. That lower high made a new low. So, definitely. And gold, boy, gold, if it holds below here, I think it's the end of a wave 5. It might be in for, this could be the end of a wave 3 on the daily. Maybe. I kind of doubt it, but we would have to see a good breaker structure and reevaluate, but maybe end of a wave 3 if it turns. And the S&P 500, yeah, I definitely think it's still in an uptrend. So anyways, yeah, it's things are looking pretty solid, definitely. I'm going to hold on to my dollar trades. I'm in $2 trades. I'm in one Swiss trade, and I got a euro pound that I've been holding for a week or so. And yeah, that's it for now. So as always, definitely don't forget to like and subscribe and watch my full videos. And as always, thank you.